Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Market conditions have put the local startup scene under a lot of pressure over the last 18 months. Company valuations have been cut dramatically and staff laid off as businesses dealt with soaring inflation and higher interest rates. But it's not all bad news. In fact, that same period has seen one family office invest in 35 startups and 20 funds. Euphemia is the family office of entrepreneur and investor Dominic Pym, himself a bit of a startup guru. It's run by Judy Anderson-Firth. Judy is CEO of Euphemia. They're taking a different approach to startups, looking to supercharge the whole ecosystem by backing those who are in turn backing others. As I mentioned, Judy Anderson-Firth is the CEO of Euphemia. Judy, welcome to Fear and Greed.
Thanks for having me.
So just explain that. You are backing those who are backing others. Just explain what the process is, what the methodology is.
That's right. So one of our missions is to go big and grow home. So we're both, Dom and myself, quite passionate about the Australian startup ecosystem. And we believe that you can build a high growth, high successful company from Australian soil, even if you're serving a global market. And the good news is that now Australia's venture sector is significantly more mature than it was a decade ago. So it's actually a really great time to be deploying capital into the venture landscape, we think, in Australia. So, backing the people that are backing others, for us, what that means practically is investing in venture funds from pre-seed up to private equity, who are then investing in Australian startups who are globally successful tech companies, or soon to be.
So have you invested in many companies directly, or is it in the VC startup capital space?
Yeah, that's right. So if you zoom out on the Euphemia group, the main categories that we do work in, we have the venture portfolio, which includes investing in funds, as I've already mentioned, sort of pre-seed up to private equity, investing directly into startups across four main verticals, which is fintech, climate tech, women-led startups, or really any founder from a diverse background who hasn't had equal access to opportunity, and then startup infrastructure, which is a niche corner of B2B SaaS, where you're a high-growth tech company whose customer is a high-growth tech company. And then we also have the Euphemia syndicate. So if you wanted to invest alongside us in some of the deals that we're doing, we share those on a platform called Aussie Angels. And so you can invest alongside us for as little as 5K up to as much as allocation will allow. And again, it's on those same four verticals that I just mentioned. More broadly, the group also has a property portfolio, both commercial, residential, a share portfolio, which is mostly listed US tech stocks, and then a foundation to help people in need. But the bulk of the work that we do is with startups and founders and funds directly.
Okay, so Judy, you're the right person to ask. What has the last 18 months been like for startups in Australia? Now, you've obviously invested a lot of money in funds who are looking at startups, so you must have some confidence about the future, but let's start about the past, the last 18 months or so.
Yeah, the last 18 months has been a lesson in the ability to pivot on a dime and tolerance for ambiguity, both in the founders who are running these companies, trying to raise capital and grow their businesses, but also those who are deploying capital into those companies. So what we saw, towards the very start of 2022 was the sort of frothiness in the market start to temper down. We did have very high valuations all throughout 2021 when there was that post-COVID boom and everyone wanted to keep going and there was lots of capital and money was cheap. And then as interest rates started rising, obviously confidence starts to reduce and risk appetite also starts to reduce in market. And so what we've seen over the last 18 months is really a repricing of the entire asset class of private equities. And we're seeing across the board, the average would be about a 20% haircut from the last time that these companies were raising capital is what we're seeing on average across the board. And so what that means is that we're seeing check sizes being actually a little bit bigger for the companies that are getting invested in. Like the good companies are still getting funded, the ones that have your fundamental metrics. They've got a good innovative value proposition. They have customers that actually still want to pay money for that product or service. And there's a growing market opportunity. Those companies are still getting funded, but the rounds are taking longer. Like they're taking on average between 3 to 6 months longer than it was in the previous 18-month period. And so instead of raising 12 months of runway, we're seeing companies raise 18, sometimes in some instances up to 24 months runway. So valuations are down, but the check sizes are a bit bigger because companies are needing more runway to get to the same equivalent metrics that they were in previous rounds. And we are seeing that there is overall still a general slowing of pace. So the deals are getting done, but they're taking a bit longer and they're just not quite as frequent as what we saw. We're also seeing a lot of companies that probably weren't going to be successful. It's just putting the foot down on failure. Like the accelerator pedal is to the floor, because if you can't raise capital and your customers are no longer paying money for your product or service, because it's sort of the first line item to go when a P&L review was done, we're seeing those companies are actually being wound down in a shorter time frame than we would normally expect to see.
Okay, so much to unpack in that. The one thing that just jumped out at me was you were talking about what you do like. So if you are thinking about investing, or one of the companies you've invested in is thinking about investing in a startup, what is it that you're looking for? Obviously, cash flow is one. So I suppose what are the things you want and what are the red flags?
Yeah, the fund managers that we back, again, like we're backing our belief in their ability to invest that capital really well, that they're going to find the great companies, and that they're not going to miss that 1 in 100, win in that season, or that vintage of companies. And so when we are assessing a fund manager, we're really looking at like the quality of their deal flow. So that are they seeing, companies that we wouldn't see directly or that other venture funds may not be able to see? So do they have great relationships with, industry bodies, with the accelerators in the country, with community groups, and of course with like experienced founders and the executives within them, because some of the best companies are actually built from the employees of successfully exited tech companies. So their ability to have great deal flow, can they move fast? Can they do quick due diligence? Can they actually just make the call and move through quite quickly so they can be competitive if it is a quick round where there's competition for allocation? And of course, it's then down to like portfolio support. Like, what does their portfolio support look like? How do they then, once they've written the check, that's really just the start of the relationship. It's not the finish line. It's really the starting line. And so what happens after that, when they're in the portfolio? What does support look like? How can they give them an outsized advantage to scale and get to that next milestone? So what do their relationships and networks look like outside of Australia into larger markets where those companies may be expanding, either to other co-investors who can go on to lead future rounds or to help them hire talent in emerging markets? So it's really how good is their deal flow? How quickly and diligently can they move through the execution process and make confident decisions in investment? And then what does their portfolio success look like after they've invested?
Okay, so the red flags are not a lot of deal flow, not a lot of after sales service, that type of thing.
That's right. Yeah. Or even just sometimes when there's just too much sensitivity to pricing. Everyone loves to get a good deal. Don't get me wrong. We love a good deal. But, I'm not the first person to say this, but, the only prices that really matter from an investment point of view in this asset class are the first one and the last one. And so if you're spending too much time haggling on price and valuation, you're just eroding value for everyone, for the founder, for the company, for the investor. So as long as it's within a normal range, best to just lock it in, execute, and keep moving.
Stay with me, Judy. We'll be back in a minute. I'm talking to Judy Anderson-Firth, CEO of Euphemia. How much do you think about the exit price when you're entering? Now, I appreciate you are investing in companies who are investing in startups, but still there's a flow through there. How much do you think about the exit before you start?
Definitely, it's part of our due diligence process, especially when we're investing in a company directly. So we do have a direct portfolio of about 50 companies and startups in those 4 verticals that I mentioned earlier. And so what the exit looks like is definitely a part of our getting to know you conversation with the founder. Like, we have to understand their ambition. Why are they building this business? What type of business are they trying to build? Because it just reframes what sort of relationship you're going to have with them, like what type of company they're trying to build totally changes what check size you write, what support you may or may not provide to them, once they're in the portfolio, what they need. So, we're not unicorn zealots. We believe that you can build a really great, successful, $500 million business. You don't have to be a $1 billion business to be, it's not binary outcomes of success and failure. We know there's a sliding scale, but definitely understanding their ambition is important. Like, do they want to be, the type of company that's like running a quick race, 3 to 5 years, a quick exit to a Microsoft, a Google, or, a company like that? Or do they actually want, are they on a, multi-decade journey where they want to be the next Google? Like, they're totally different companies that need totally different capital requirements. So definitely a part of our getting to know you process.
Okay, just coming back to your direct investments, talked about fintech, I get that, climate tech. Even startup infrastructure, to some extent, I understand that one. Startups led by diverse groups, women-led startups, for example, or those who haven't had the opportunity, perhaps, to access capital. How have they gone? Like, what's the thinking behind that?
Well, there's a gigantic need. And not just is there a gigantic need, but there's also a gigantic commercial opportunity. So, all of the research that's been coming out of the analysis of the venture community, not just here in Australia, but globally, is showing that more diverse teams are actually providing significantly better return outcomes for the investors into those companies. So, where there is a woman in the co-founding team, women in the executive hires in the early stages, and then later on onto the boards of those companies when they get to later stages, they're significantly outperforming their all-male counterpart teams and companies. And so it's not just that there's a gigantic need in the market for funding to go to women-led startups. There's also a great commercial return. So for us, there's a competitive opportunity to be deploying capital where perhaps the rest of the market isn't deploying capital. And then there's also, of course, like just the impact of it. Like there are so many amazing women entrepreneurs in our community that are going underfunded. The stats I won't get right off the top of my head, but it's close to 2% is the equivalent that women entrepreneurs have gotten over the last 12 months in the amount of capital that's been deployed compared to their male counterparts. And in this market where risk appetite is going down, we're actually seeing those statistics are getting worse because when times are good, we're more likely to take a risk, and investing in things that go against our unconscious bias are actually perceived as riskier. And so we're seeing that those investments are actually going down rather than going in the right direction. But the good news is that the industry is aware of this. Like no one, you'd have to be living under a rock to not know that there is a need to balance the ledger for the amount of investment capital that's going into women entrepreneurs. So there are some amazing groups that are doing work. I mean, a shout out to Carol Schwartz and her team at the Trawala Group. They're doing an incredible job of investing in women-led funds. So again, for us, what that looks like is not just investing in funds that invest in women, like Scale Investors, the Artesian Female Leaders Fund, Aliavia Ventures, but companies that are actually not necessarily deploying capital into women entrepreneurs. They are, but they're equally deploying into men entrepreneurs, but they are led by women. They are GPs that are women. They are partners that are women. And those funds like Airtree Ventures, Jax Vollings there, she does an incredible job. Both Marissa and Kate at Aliavia Ventures. Like I could go on. There are some incredible women like Kylie and Rachel from Flying Fox. Like it's those kind of groups that we're investing in, because the more investors that we have in decision-making roles, the more we can remove unconscious bias and get more investment dollars into women.
Judy, thank you for talking to Fear and Greed.
Thank you for having me.
That was Judy Anderson-Firth, CEO of Euphemia. This is the Fear and Greed business interview. Remember, we are not an investing podcast, and if you are going to make an investment decision, you should always seek professional advice. Join us every morning for the full episode of Fear and Greed, Australia's best business podcast. I'm Sean Aylmer. Have a great day.